When we're doing velocity banking with our credit cards, the first thing we want to look at is which of our bills do we have to pay with cash. Now, I've marked all of these in the green, everything that should be paid with cash. These are all bills that are going to come directly out of your bank account, either as an ACH transfer or you're paying it with your debit card, or you can pay it with cash. Then you want to go through and look at your credit card statement dates. Then looking at the credit card statement dates, you're going to try to decide which one of your bills you're going to put on each of your credit cards. So here we have the same problem like we've had in the last couple budgets, where a lot of these statement dates are around the same time. We have one that closes on the 6th, but the rest of them don't close until the 23rd through the 26th of the month. So what I would do in this situation, I would put all of these bills right here up until the 20th on this Capital One card. And then anything due after that, I would put on one of these Discover cards. They want to pay down both of these Discover cards, which is why I would use those. I do like using my Chase card because I do like the rewards that comes from the Chase card. But for this example, we're probably not going to use the Chase card much, and we're not going to use the Quicksilver card much. With the miscellaneous spending, these aren't always going to be on the same day every month, so it kind of just depends on your paychecks, your credit cards, and the other spending that you have to do throughout the weeks. But they get paid weekly, so let's take a look at that. Okay, so October 1st, they get paid $2,600. Their cash expenses are their mortgage, PayPal, taxes, and IRS. That's $1,692 that comes directly out of their paycheck first before anything else gets paid. So we'll do 2,600 minus 1,692. This means $908 is left. So we take the $908 left after the cash expenses, pay it to the Capital One card. The due date for the Capital One card is the 1st, and then the statement date is the 6th. So we pay $908 to this card. When the statement closes on this card, they're also going to add probably about $70 for interest. Now this card balance is down to $2,119. It is going to report at this amount. So this is going to help the credit score because we started at 2,957. The balance is now going to report at 2,119, even though we're going to put things back on this card. So we got the paycheck, we paid the cash expenses, we paid the rest to the credit card. Now these are all the bills that are going to go back onto this credit card. So we have $730 going back onto the card. Now this card balance is at $2,849. Once this card gets to $2,847, you stop spending on it. You have to make sure that you have your spending under control if you're going to use this method. Now with the second week's paycheck, we're going to take some out for savings and put that aside, so $200. Then this time, we don't have any other cards closing and we don't have enough on this card to pay all of these bills. So we're going to have to pay these bills first before we pay the credit cards on the second paycheck. This food and miscellaneous expense, you're going to see this every week because I added these up and divided them by 4 weeks and just split them evenly across the week. So they may not spend it exactly like this, but this is just an example. So we have 1,300 minus 200 minus 286. This leaves $814 to pay to the credit cards. So we're paying $300 each to the Discover cards and then $214 to the Quicksilver card. Remember, this is one of those cards that we weren't really going to use. So we pay $214. Now we're paying this card on the 10th, even though it's not due until the 15th and the statement date is not until the 23rd. But again, we're not going to use this card. On the 23rd, the statement closes. They're going to charge interest, probably around $90. Now this balance ends at $3,766. Remember, we're not doing any spending on this card, so all you should be doing is paying it and waiting for it to close. Now again, both of these cards aren't due until the 20th, but we're paying them early and then we're going to go in and pay them again before the statements close. So we're paying $300 to each card. Now again, these statements aren't going to close yet, so we'll worry about that when that paycheck comes. Now remember, they're paid weekly, so we're on week 3. We get $1,300 in income. The car expense comes out, which is $467. Again, here, we didn't have any credit card statements closing, so this will have to come before the credit card payments. So we take $1,300 minus $467 minus $415. $418 is what we have left to pay to the Chase card. Again, we planned on not using this credit card. The minimum payment on this card is $415, so we're barely covering the minimum. So we're paying $418, which actually might have been an error because compared to the balance on this Chase card, that's a pretty high minimum payment. But anyway, we'll just use these numbers for the example. Now we're paying this card on the 17th. It's due on the 20th. It closes on the 23rd. On the 23rd, they're going to go in and charge you interest. The interest is probably around $127. This was one of those cards that we were not going to spend on, but the balance is still going down because of that minimum payment being so large. So the balance would now be at $1,541 and it would report at that amount. Again, helping your credit score reporting at that lower balance. Now with the fourth paycheck, we only have one small cash expense of $69, so we subtract that from the $1,300. And this time we pay everything else to the credit cards because these bills aren't due until after the credit card statements close. So remember, we already paid the 2 Discover cards and we paid the Capital One card at the beginning of the month. We're going to go back in and pay all of those cards again. So $400 to each Discover card and then $431 to the Capital One card. So we're going to go in and add another $400 payment to each card. Now both of these cards until December have 0 interest, so when the credit card statement closes, they're not going to be charged interest on these balances. So what is paid to the cards is actually what the balance is going to be going down. This balance would be at $8,838 and it would report at that amount. This balance would be at $5,986 and it would report at this amount. Again, helping the credit score reporting at those lower balances. Now we've paid the cards down, but we have $959 that needs to go back onto these 2 cards. And you can decide which of these bills you want to put on each card. Let's say you used one only for the car insurance, so $608, and the remaining $351 would go onto the other card. Remember, the balance is already reported at these lower amounts, even though the balances are going to go up. Once we put those bills back on there, we're going to pay these cards again before the statement closes, and the balance will be even lower than this. So once this balance gets to $9,189, you're going to stop spending on that card. And when this balance gets to $6,594, you stop spending on this card. Now remember, I said we're going to pay the Capital One card again. So the balance was back up to $2,849. $2,849. We're going to go in and pay $431 to this card, which brings the balance down to $2,418. Now we've made an extra payment to this card because on the first of the month, the first paycheck that we get, we're going to go back in and make the same $900 payment that we did the first of the last month. So now pretend we're no longer in October, now we're in November. The dates are going to be slightly different, but they still should have the same bills on each paycheck. So we get the paycheck, we take out the cash expenses. There's that $908 that's being paid to the Capital One card. So we pay another $908. Then let's add $67 for interest. This balance will now report at $1,577. Remember, the last time it reported was at $2,119. So again, helping the credit score, it's always going to report lower every month. And then after it reports at that low amount, we go back in and put the $730 back onto that credit card. So again, the balance is going up. So you do have to get used to your credit card balances going up and down and up and down. That's just how it works. If they wanted to, they could pay smaller amounts to this and start paying a little bit more to that Chase card just so the balance goes down some. It's just an option. There are many different ways that you can figure out how to do this, but you do have to look at your paychecks, your cash expenses, when your other expenses are due, or when you plan on doing your spending, and then when your bills are due after your credit card statements close. Another thing you can do, remember the 2 Discover cards that closed at the end of the month. There is still room on these to do some spending. So if you wanted to, instead of paying these expenses here directly out of your paycheck, you could put these expenses on these 2 cards. That would free up some of this paycheck to have extra to pay to the credit cards. Right now, they've been cash stuffing their food and spending, so that's why I left 2 weeks of it where they are probably still going to cash stuff, and then 2 weeks where they're going to put it back onto a credit card. Maybe they can get used to putting it on a credit card and making that work. When you're doing velocity banking, you have to plan exactly what is going back onto the credit card, and then you have to know exactly when you're going to stop spending. So again, with the Capital One card, we paid the payment early. We paid it again before the statement closed. The interest came out. This was the balance that was reported. Now we plan to put $730 back onto this card. The balance will then be back up to $2,307. That's when we stop spending. So when the balance gets to $2,307, we stop spending, or the way I like to do it is look at the available credit because it updates instantly. Sometimes your balance can take a few days to update, so it's best to look at the available credit to see when you're going to stop spending. So if we're stopping at this balance of $2,307, the available credit would say $943. So when it says available credit $943, you do not do any more spending on this card. I always like to set these stop spending limits no matter which number I'm looking at. That way I know when I'm going to stop spending on the cards. The first month of doing velocity banking usually is the most difficult because we do have these expenses that can't always be put on a credit card the first month. Whereas the second month, usually you've freed up enough on other cards that these expenses can go on those if you wanted to. But again, it's just something that you have to look at. If you have any questions about velocity banking, credit cards, credit scores, or anything else, let me know.